Hello, everyone. Welcome back. Another important update. We're currently in March of 2024. Specifically, today is March 20th, 2024. We are eagerly awaiting the Fed minutes and where the Fed is thinking about going in terms of future interest rate cuts or increases or not or neither. But I believe that there is rising evidence that we are currently blowing an equity bubble while at the same time corporate profits are vulnerable. And so let's take a look at exactly why I think that. This is in continuation of the ongoing Lunch and Learn webinar series that I present here on a bi-weekly basis here at Zacks Professional Services. My name is Mayur Thaker. I'm an equity strategist here at Zacks, and this is the March update that we can go ahead and talk about. So a growing number of valuation metrics, again, this is my opinion, but a growing number of valuation metrics currently are warning that we're entering valuation territories that we have not seen since more than 20 years, really exiting the dot-com bubble burst in 2000, 2001. And at the same time, there continue to be risks to S&P earnings. And we'll take a look at exactly what they are here on this slide. I still believe, as I have been talking about for the past 15 months now, that I still believe that we are in the process of entering recession. We aren't in recession yet, but the leading indicators of the economy, in my view, are still pointing in that direction. And they are specifically the manufacturing sector. Manufacturing is a cyclical industry that is affected by macro cycles, and they actually start to react first before other industries begin to react. And the reason for that is because there is a strong track record of that happening over multiple cycles. You can see manufacturing beginning to turn down ahead of recessions and beginning to turn up ahead of recoveries. So manufacturing has consistently been a leading indicator for the economy. Manufacturing, according to multiple gauges, has been in recession for 16 months now. That is a very long time, and it continues to be that through February. So that is something that we cannot just simply ignore. The inverted yield curve, we know that has a very strong track record at capturing the early parts of recessions. The leading economic index by the Conference Board, that's been in contraction for 21 months. Excess savings has been in contraction as well. It's well below trend. It's forecasted to basically be depleted by the first half of this year. That's still on track. GDI has not confirmed GDP. And the leading indicators of employment and credit are in contraction as well. And we'll see that for the first time, something big happened in February. I'll talk about that in a minute. And unlike in past environments, the Fed is not supportive of stocks right now, because right now the big thing that they want to focus on is getting inflation under control. And I think Jay Powell has been very clear that that is priority number one, not saving the stock market. So this time is quite different in terms of where the Fed's head is at. So cyclically adjusted PE, market cap to GDP, equity risk premium, all three of these are approaching, not yet at the top or the peak that we saw in 2000, but are approaching the territory that I would consider bubble-like. You can see that total market cap to GDP is at all-time highs. It has surpassed the 2000 peak. Now, of course, this is a little bit misleading because companies today are more global than they are or than they were in 2000. So you can see that even though the market cap to GDP is higher today than it was in the 2000 peak, market cap of the S&P 500 derives from revenue that comes globally, right? And earnings that can be sourced globally. So it's a little bit misleading, but you can still see that we are at elevated levels. It's not something that we can ignore, especially when it's in conjunction with other valuation metrics. Here we see the Shiller PE, the inverse of that, which is called the CAPE yield. The CAPE yield is a very strong positive correlation to forward 10-year returns. As you can see, stocks got very cheap in 1929, and got very expensive in 1921, and they got very cheap. So the market had a very strong forward 10-year return in the roaring 20s. And then, stocks got very, very expensive by the end of that decade. As you can see, the CAPE yield was basically negative at that time. And so the 10-year forward return was very, very lackluster. So you can see that it has a very strong positive correlation. And here you can see where the CAPE yield is at now. It's at 1.4%. This is through January, I believe. And so the forecast forward 10-year forward returns are, in my view, going to be very, very low. You can see that we're at the lowest CAPE yield that we have seen in really dating back to 2002. It's not quite as bad as it got in 2000 at the market top. So that suggests that we could still see more upside, but it's time to be cautious is what I'm trying to say here. Valuations are not cheap by any stretch. If you look at, traditional metrics like PE and others like that, yeah, we're way off the highs of 2000, but, multiples should not be looked at in isolation. They should always be looked at relative to the inflation picture as well as the interest rate picture. And that's what the CAPE yield does. It looks at the earnings yield on a real basis, as well as on a adjusted basis for the 10-year treasury yield. So this is looking at real earnings yields as a spread to the 10-year treasury yield. And you can see that has narrowed now to the greatest extent since basically 2002. On a similar note, this is the equity risk premium. This looks at the S&P 500 forward earnings yield spread to different maturity treasury yields. You can see that the blue is relative to the 3-month, the blue is relative to the 10-year treasury yield, and the dark blue is relative to the 3-month treasury yield, as well as the black is relative to the 1 year. You can now see that the earnings yield for the S&P 500 is now negative, meaning the yield is lower than where the 3-month treasury yield and the 1 year treasury yield are, which that has not happened, again, dating back to 2001. So again, stocks are not cheap by, if you look at it on a adjusted basis relative to some measure of interest rates. Because remember, multiples are a function of growth, but they're also a function of the cost of capital. And the cost of capital can be best captured by where the treasury yield is. And here are, a mix of 3 different treasury yields. And by each and every one of them, that spread is at the lowest levels that we have seen going all the way back 20 plus years. So stocks are not cheap. And in fact, we're approaching bubble territories that we saw last in 1999. But still a ways away from their worst levels. So yes, there's no rule that says that this is the top and stocks have to come down from here. There's no rule that says that this can continue to get worse like it got all the way down here to minus 2%. So that could definitely happen. And I think that might actually will happen, in fact, given where we are with the trend of the price action of the S&P 500. Traditional PE, price to free cash flow, or EV to EBITDA, are still lower today than they were in 2000. So traditional valuation metrics are not yet, that expensive. But again, I think that falls into a pitfall. You have to look at multiples relative to the cost of capital. And this is happening despite rising threats to corporate earnings. So as I mentioned, there are, multiple leading indicators that point to a very difficult road ahead for S&P earnings. And so we're in bubble territory despite rising risks to earnings. If we were in bubble territory, but the earnings trajectory remains strong, that manufacturing is in expansion, other leading economic indicators are in expansion, then I would say, well, the threat is mitigated because of growth. But as of right now, that thesis is being challenged. Here we look at the inverted yield curve. Again, you can see how strong of a track record that has had each and every time. The last 3 recessions, we've had an inverted yield curve prior to the recession. But as you can see here, they happened well in advance of the start of recession. So we're still within that ballpark. Sometimes the average recession could take 3 to 4 years. Sometimes in some cases it could take up to 4 years before the recession starts. Like we had the inversion in 1989. This is the 10-year yield minus the 2-year yield. It happened in 89. The recession didn't actually begin until 1990. So that was, this is 1988 to 1990 or early 1991. So that was almost a 3-year advance notice. And that's kind of what we're looking at here today. We got the inversion in 2022. We're now in 2024. So we're still not like outside of the norm. Here we got the inversion in 2006, and it didn't start until, really late 2007, early 2008. That was a 2-year advance notice. So we're still not yet even at the 2-year anniversary. We're still in the 21st month of the inverted yield curve. So really what I'm watching is the reversion, or the re-steepening. That's what happens when things are about to get truly rocky, when it goes from inversion to re-steepening above zero. We haven't even gotten to that stance yet. So, the Treasury yield curve is warning of recession coming, but it's not telling us that recession is imminent right now. Just to be very aware of, rising risks. Now, here's why the market is bullish, right? We saw very strong Q4 earnings. Q4 earnings came in at almost 6.5% year over year. And that's representing accelerating earnings growth rates. You can see that, earnings were actually in decline for 8 consecutive quarters on a year-over-year basis. You can't see that on this chart here, but you can see that earnings were still in decline in Q1 and Q2 of last year. And then Q3 was that inflection point where we went from, contraction to growth. And Q4 built upon that. We went from 3.8% year-over-year growth in Q3 to then 6.5% in Q4. That's actually expected to come down in Q1, but you can see that analysts are still very bullish for the rest of 2024. As you can see that they're expecting a very strong acceleration in earnings this year. However, because of the leading indicators that I've been watching and talking about, estimates are starting to come down. So I believe that there is a big risk to these numbers. Remember, the market is very bullish on earnings that haven't yet materialized, except for the strong Q4 number. The market is strong on a very high expectation that we will see a cyclical earnings recovery this year. That was pretty much supported and buoyed by the fact that we had a very strong Q4 earnings season. But again, as we continue to get, negative readings on leading indicators to earnings, specifically in manufacturing, that's going to present a rising risk to that earnings expectation of a strong recovery this year. And I think that analysts are already starting to, price that in. As you can see, in December, Q1 expectations were at 6% growth year over year. That's been tapered down to 2.5%. So they're constantly kicking the can into future quarters for growth. But ultimately, that's going to weigh on the full year earnings picture. And as you can see there, it has started to weigh on it. We're basically down to, where we were on earnings expectations back in July. This is the aggregate 2024 earnings expectation for the S&P 500. We're basically matching that July low. And again, I believe because of the leading indicators that I'm watching, I'll talk about that in a minute. I think that this number is going to continue to come down, and that presents a risk. Now, here's why I think a major thing happened. Let's take a look at the job market. We, for the first time this cycle, got the permanent job losers. Remember, this is contained within the monthly jobs report on table A11 on the BLS website. Permanent job losers, this is a, based on the survey of establishments, meaning businesses. And basically this tracks how many jobs were canceled. And for the first time this cycle, permanent job losers crossed above the 3-year moving average. And as you can see, the reason why I use the 3-year moving average is because that is significant, because every time, permanent job losers crossed above the 3-year moving average, we have seen a sustained rise in job cancellations. We have seen a sustained rise in the number of jobs that companies end up canceling, or, basically the number of layoffs that companies have issued. This is not a good picture. And so we, for the first time this cycle, got a crossover of that 3-year moving average. Now, there's nothing magical about 3 years. You could do 4 years, you could do 5 years, you could do 1 year. But, this is not something that we can simply dismiss. Remember, the biggest reason why we have had such a strong economy and strong markets is because the consumer has been strong. They've continued to spend. Remember, retail sales or personal consumption is 60% of GDP. And when everybody has jobs and when we have real wages that are rising, that number is going to continue to be very strong. But the moment that we start to see layoffs starting to tick up, and we have now, that thesis comes under very, very strong challenge. And so for the first time, this to me is very significant. This is the beginning of what I think is going to be a tightening labor market, where jobs are going to become rarer and rarer, and fewer people will be holding full-time jobs. And as we saw here, full-time jobs are actually down, and this is a typo, it's actually 1.8. We are now down 1.8 million full-time jobs since the peak in June of last year. Here you can see that number. Full-time jobs minus 1.84 million from the June peak, well below pre-pandemic trend now. You can see that if you were to draw a trend line throughout the 2010s here, we're well below peak. We were on the way back to getting to trend, but now we're pulling a U-turn here, and full-time jobs are now down. That's significant, because this, to me, tells me the quality of the jobs picture. Because remember, we got 2.7 million new jobs over the past year, and yet we're down almost 500,000 jobs if you look at full-time job creation over the past year. So the great headline number that we're seeing is entirely part-time jobs. And I don't think that is sustainable, because you can't have retail sales growth continue its pace that it has been with more and more people working part-time and fewer people working full-time. So if the mix between full-time and part-time jobs starts to tilt towards more and more part-time jobs, then that means that real weekly earnings or real monthly earnings or real annual earnings are coming down. And that's exactly what's happening. So as incomes start to fall, where more and more people are working part-time jobs versus full-time, that's going to present a serious threat to retail sales. And again, retail sales is the core part of the U.S. economy. So again, if you go back to the aggregate number, this is the non-farm payrolls number that you see here in black. That's a very robust 1.8% growth year over year as of February. But if you look at cyclical jobs, so this is from industries that are not government or government adjacent, like education and healthcare, cyclical industries have cut jobs now by 0.4%. You may say, well, that's not a big number. It's not, but this number never goes into contraction outside of the onset of recession. You can see that it goes negative in 1990. Just ahead of that recession, it went negative in 2000. Just ahead of that recession, it went negative in late 2007, just ahead of that recession. Obviously, there was no time to react during the COVID crash, but we're now in negative territory here again today. Again, this is a leading indicator to the job market, and it's now in contraction. And as you can see, each and every time, aggregate non-farm payrolls, eventually follow suit as long as this remains negative. And this is now negative now for the 8th consecutive month. I don't think that you can continue to just simply dismiss that. Unless if we get a recovery, back above zero, which for the first time, that would happen for the first time ever. But 8 consecutive months, eventually, the non-farm payrolls number, the aggregate number, is going to catch down to this number. Again, this is because this contains leading economic industries such as plastics and rubber manufacturing, such as trucking, such as administrative jobs, such as warehousing jobs. These are the jobs that get cut first ahead of economic cycles turning up or down. And, the same applies on the upside. You can see that, they also recover ahead of the aggregate data recovering. So you can see they bottom out and start to recover ahead of the aggregate numbers. So this turns up and it turns down ahead of the non-farm payrolls number. And so this is now in negative territory. So temporary help services is one component of that index that I constructed. And you can see here that this turns negative ahead of recessions. And it's now, in contraction, just like it has done each and every time ahead of the past several recessions. Average weekly hours, because we're getting this shift from full-time to part-time jobs, the average weekly hour, the average work week has now been getting cut consistent with past recessions. You can see that we're basically down to where we were during the pandemic. Not quite to the worst levels here, but that number has come down. Now, we're not substantially different from where we have been throughout the 2010s. So this number has not yet started to show serious concerns. But if we get down to 34, I would start to get very, very worried about where this entire job market is going. Consumers, you can see, are showing signs of stress because of all of these things combined, though. You can see delinquencies are rising significantly, within auto loans and credit cards. We're now at the highest levels of delinquency going back, exiting the great financial crisis of 2009-2010. This has now surpassed the peak of the COVID recession. And we haven't seen, levels this high since, exiting the great financial crisis. This is not good data. If individuals were healthy, if consumer balance sheets were strong, if personal incomes were strong, then you would not see delinquencies in auto loans and credit cards this high. Mortgage debt is still very healthy, but obviously everybody prioritizes how they pay down their debts, right? Because mortgages, nobody wants to lose their house, so they prioritize, right? So this is what tends to happen at the start of economic downturns. They start to prioritize. Well, credit cards, I'm going to try my best to pay that off, but if I can't, so be it. I'd rather pay my mortgage first and deal with other, debts after that. So, because nobody wants to lose their house, but they're okay if they default on their credit card or on their car payment, because it'd be much preferable to lose your car versus losing your house. So people are making tough choices. So mortgage default, rates are very low, but it's very, very concerning to see auto loans and credit card default rates rising. And you can see this being reported by Discover and American Express. Discover is a bellwether in my view, because they have over 60 million cardholders, most of which are middle class. That's their entire business model, is to focus on the middle class, shopper. And you can see that they have been reporting rapidly rising provisions for loan losses. So this is hitting their earnings right now. Even American Express, which doesn't even cater to the low end consumer, they cater to the high end consumer, and even the high end consumer are showing signs of distress. Now, this is not a big number. It's not a big deal for American Express because these numbers are very small relative to their overall picture. But for Discover, it's not. So you can see that there is rising stress among middle class consumers out there. There's also a large gap and widening gap between the household and establishment job surveys. This suggests that the job market is much weaker than it appears. It also suggests that a lot of people are holding multiple jobs. It could be that, jobs are being created by businesses, but multiple people the same person is holding multiple jobs. And so you could see that, remember the establishment survey can double count jobs because you could have two jobs being created by two different businesses, but the same person holds both of those jobs. And so that's why the household survey sometimes can be more important from a personal finance standpoint to assess the health of the individual. When we see the household survey starting to contract here, that could mean that there is signs of stress for individual households. And that's what we're starting to see here. And here it is kind of zoomed in. You can see that, the non-farm payroll number is very healthy at 1.8% year over year. But the household survey is basically at its lowest growth rate in any non-recessionary year. So again, if the full-time job contraction is due to attrition or demographics, like if baby boomers are just simply retiring and companies aren't really replacing them quickly, then that could be bullish actually, because that means that operating margins could be rising for the S&P. But if the decline is actually due to the fact that there is slowing demand out there, then that is bearish. And we have started to see that real average weekly earnings, personal savings, default rates, that's very bearish for forward-looking retail sales. And here we have it. And here's a chart of retail sales on a real basis. This is adjusted for inflation. We just got the February update, and that was negative, 1.6% year over year. That's not good. These are not very bullish numbers. And this is the reason for that is, again, we are starting to see the early parts of rising job losses, as we saw from the spike in permanent job losers. We are starting to see cyclical industries contract in terms of total job creation. We are starting to see rising delinquencies as a result of that. Again, the combination of all this is very bearish for personal balance sheets, personal incomes, and therefore real retail sales. And that's why we're seeing that negative print now for 2 back-to-back months. Manufacturing is another source of weakness. We've been in contraction by ISM manufacturing PMI for 16 consecutive months, and we're starting to see a bearish divergence with forward earnings. This is the reason why I bring this up, because this has a very strong track record at forward earnings growth expectations for the S&P. As ISM expands, so does S&P earnings growth expectations. And as ISM contracts, so do forward S&P earnings expectations. And you can see that has had a very strong positive correlation now for 10 plus years. You could see the rising ISM during, starting in 2015 through 2019. And we saw rising earnings expectations. We then saw a drop off in manufacturing from 18 to 20. And similarly, a drop off in earnings, followed by a very strong recovery in manufacturing, strong recovery in earnings, drop off in manufacturing, drop off in earnings. But look what's happening recently. We're starting to see a bearish divergence. We are not seeing, manufacturing rebound the way that analysts currently think the S&P will do as far as earnings growth is concerned. So eventually this gap needs to be filled. Either ISM needs to bounce back up to confirm what analysts were expecting, or analysts could be wrong and earnings are going to contract and catch down to manufacturing. I think that that's what's going to happen given everything else that we're seeing. And here that is zoomed in for the first time, so we saw the very strong positive correlation here on the way down, and yet we're now seeing a divergence on the way up. This is why I believe that analysts are too bullish on earnings expectations for this year. And I think those estimates will start to come down. We will see where that goes. Again, other leading indicators like ISM new orders, that's one of the subcomponents. Again, back in contraction. We had 18 consecutive months of contraction. We had a 1 month bounce back. And once again, we're back into contraction in February. So this number needs to start staying above 50. It needs to start, expanding once again consistently for me to get bullish on S&P earnings. But as of right now, it continues to be bearish for earnings. Factories continue to slash the work week. You can see manufacturing work week hours have been cut quite dramatically. We're at the shortest work week, basically outside of any non-recessionary period. So again, the work week is down to where we were during COVID, during 2008, worse than the bottom of 2000. So again, this is not very bullish. You can't have aggregate GDP growth without manufacturing. Manufacturing is a very core component to the American economy. Even though it's only about 10% of GDP, it's not about the size or the contribution, but it's about the correlation. So as manufacturing turns down, so does economic activity elsewhere, in services, for example. And manufacturing, for that reason, is a leading indicator. And that's why I like to focus on manufacturing first, because if you focus on other indicators like GDP or, industrial production, the ISM services, for example, you're just going to be falling into the trap of coincident indicators. By the time GDP rolls over, the market's already going to be down 20-30% in a recession. So you'll be catching it too late. So that's why I like to focus on the forward-looking leading indicators like manufacturing, like cyclical employment, like the yield curve, which is inverted. And history has shown that forced inversion breaks things. This is looking at the Fed funds rate versus the 2-year yield. Again, this is deeply inverted. Whenever this happens, again, this is the buildup to a recession, in my view. And all these leading indicators are captured quite nicely by the Conference Board's leading economic index. That's been in decline for 22 consecutive months now. We get an update on that tomorrow, actually, on Thursday, March 21st. I'll be watching that very closely. Another reason why I think retail sales are at risk. Again, here's a chart of real retail sales. We're down for 2 consecutive months now. And it's actually gone down consecutively for 2 years. You can see this is a cumulative chart of real retail sales over the past 2 years. We've had no growth in real retail sales for 2 years now. This is a cumulative chart of real retail sales growth. Over the past 2 years, it's down 2.9%. So whatever growth we have seen in retail sales for the past 2 years has been nothing but inflation. It's all inflation. So on an adjusted basis, consumers are spending less today than they were 2 years ago. So again, we see this extremely strong market, but retail sales, which is 60% of the U.S. economy, is down over a 2-year period. So again, all of the gains that we have seen are due to inflation. This is not actually due to actual volume growth or actual growth adjusted for inflation. So again, even though the market is on a nominal basis, so again, I get the pushback. A lot of people say, well, the S&P itself is a nominal index. The price level is a nominal price level index. So even if real retail sales are down, nominal retail sales are up very strongly. And that's true. And that's why the S&P is up. But this is done for analytical purposes to understand, are consumers healthy or not? And this picture is telling me no, because all the growth that we've seen is due to inflation. And if inflation comes down, then the real consumer is going to show up, which is negative nominal retail sales. And that's, I think, what's about to start to happen, because we now see that excess savings, which were built up thanks to pandemic era policies, are now reversing, and personal savings are now below pre-pandemic trend. And as you can see there, it's trending down and continues to come down. And I believe that the entire pandemic era, savings level is about to be exhausted in the next couple of months, pretty much by the first half of this year. GDI is another thing. I'm going to be watching this like a hawk because this number comes out on March 28th, but GDI has not been as rosy as what GDP has been telling us. This is very important because GDI represents incomes, whereas GDP measures production. Both are very important, but if income does not confirm and affirm production, then we have a problem. Because here we can see that the ratio between the two only typically breaks down during recessions. And it's currently breaking down right now. So I'm going to be watching this very closely with great interest. This is going to come out on March 28th. We will see what real GDI tells us for Q4. If this once again does not confirm the, 3.3% GDP growth that we saw, then, I think that the entire GDP series is going to be revised lower because you can't continue to have GDI not confirm GDP, because that's just too much of a divergence to ignore. So again, despite all of this concerning data, analysts are still expecting strong growth this year. But again, if we focus on the leading indicators of earnings, manufacturing, credit, cyclical job growth, permanent job losers, ISM new orders, factory hours, aggregate hours. These are leading indicators of earnings. And I think that because all of these together are in contraction, I believe that the risk for this expectation is very, very high. So I think those forecasts will be marked down. And that's going to be very bearish in my view for the market, because the market is priced for very, very robust growth. And so these estimates are starting to be revised down, as I showed here. And I think that this is only the beginning. As we continue to wade through 2024, I think these estimates are vastly overstated, and they will come down as long as these leading indicators that I just mentioned continue to remain under pressure. So recessions are always a slow buildup of things. People say, well, Mayur, you've been saying this for more than a year now, and it hasn't happened. Well, recessions are always a slow buildup of things because, look, my job is just to tell you that not everything is rosy. I want to be, in a sense, remain contrarian. Everybody's always bullish for the most part, but you can't ignore manufacturing, and you certainly can't ignore a thing like permanent job losers crossing over its 3-year moving average. Because again, these things only happen during recessions. Jobs only enter contraction from cyclical industries in or ahead of recessions. The yield curve only inverts in or ahead of recessions. Full-time jobs only contract in or ahead of recessions. the work week hours only get to these levels in or ahead of recession. So again, all these together are indicating that we are priced for robust growth, and yet there are rising risks to the economy and therefore to S&P earnings. That is a very dangerous combination. Banks continue to face a lot of difficulty. This is an important paper published by the NBER, the National Bureau of Economic Research. They found that a staggering 14% of all loans and 44% of office loans are in negative equity. That is jaw-dropping. And they even mentioned that up to 300 regional banks are at risk of solvency runs. So the Fed is in a difficult position. If we get inflation kind of starting to run back up a little bit, specifically services inflation, because goods inflation is already down quite, well, services inflation remains sticky. The Fed's going to be in a difficult position. In one sense, they have to remain tight in order to get inflation back under control, but banks are not healthy right now, especially regional banks. This is not so much affecting the big banks, but regional banks are under pressure. And it's hard to imagine a bull market when regional banks continue to see losses, continue to get cut on their earnings expectations. And commercial real estate continues to be a very, very strong headwind for these banks, and they continue to deal with these issues. And therefore, they continue to report rising loan loss provisions. So loan loss provisions, this is on bank balance sheets. This is the contra account, the allowance for loan loss. The allowance for loan losses is back up to levels that we haven't seen since COVID, and before that, since exiting the great financial crisis. So again, this is a nominal figure, so I get it. This is not adjusted for the size of bank balance sheets, but this is a paper that we can't just simply ignore. This is a major risk out there for community and regional banks that simply isn't going away. And the rate of change here is what I'm trying to really say, that, bank balance sheets really haven't changed that much in the past year, right? And yet banks are reporting rising loan losses. We never saw that during the 2000s, or 2010s, I should say. We only saw a very smooth deceleration of allowances for loan losses, followed by a stabilization. So that indicated to me a bull market. That's a very strong. That to me is an indication of strong bank balance sheets. But when this thing is rising, that to me is an indication that there is an increasing level of stress that banks are dealing with. And this is all commercial banks, by the way, combined. And as a result of all this, bank lending is in contraction. This is another indication of something that we only see during recessions. You never see banks contract lending outside of recessions. And right now, we're in contraction. Again, these are things that you just can't simply ignore. This is now a chart of regional bank earnings expectations. And as you can see, we still have not found a bottom yet. And this has been going on for more than a year, ever since Silicon Valley blew up. A big shift. There's a lot of concern with regional banks, and that concern still has not been alleviated. As you can see, analysts continue to cut earnings estimates for regional banks. So the NBER is correct. Regional banks are not out of the woods by any stretch. And if something arises out of this, if somebody else comes under stress, we just saw a New York Community Bank blow up. People still say, well, that's a one-off. Well, this is a chart of all regional banks together. And collectively, these banks are still under pressure with regards to earnings. So again, as I mentioned, Discover is a major bellwether of the health of the American middle class. Those shares dropped 10% after they reported Q4. They reported a huge jump in loan loss provisions, in credit loss provisions to 1.9 billion from 900 million a year ago, on sharply rising credit card delinquencies. And this is significant because they are a bellwether of the middle class, because they have over 60 million cardholders, most of which have middle class incomes. Now, I was shocked because Capital One offered to buy them out, so that stock rallied on that news, obviously. That was a major deal for $35 billion. I think that was a bad move by Capital One. I think they could have waited another year and probably got, the same company for a lot cheaper. But this is not a good trend. Fundamentally speaking, this is a very bad trend. And it really goes to show that consumers are feeling increasing pressure. That is not good for forward-looking retail sales, and therefore that is not good for forward-looking S&P earnings. So regional banks have not gotten out of the woods yet. This crisis is not yet over. I would not be surprised to see another NYCB type disaster come up, in the next several months here. However, despite all of this, the S&P chart is extremely bullish. So here's what I would do. So here's a summary. Earnings estimates remain strong. Okay, so analysts have not cut estimates significantly just yet. They continue to expect a very strong cyclical recovery after 6 quarters of decelerating growth. There is strong evidence, for the bulls that disinflation continues across various measures like housing, used cars, commodities. We have seen easing long-term interest rates. So together, this is a Goldilocks blend of conditions that are fueling this powerful market rally. And that's why we saw this big breakout after a 2-year bear market. We saw this big breakout. That is very, very significant in my view. So again, we have to, be cognizant of the price action as investors. So despite the fact that I've been warning now for more than a year, the market is very bullish. So we have to be cognizant of that. And so my primary conclusions, and this is where I'm trying to just warn people, not what I would actually do in terms of my investment allocation, but the warning sign, from a purely fundamental basis, is that the direction of leading fundamental indicators at the margin implies negative pressure to S&P earnings. And so that means that I believe analysts will mark down, this should actually say fiscal year 2024 and 2025 earnings forecasts. As long as the leading indicators that I just mentioned continue to be negative, I believe that analysts will continue to mark down their forward-looking earnings forecasts. Yet at the same time, markets are priced for very strong earnings growth at a forward PE of 20 to 21 times and equity risk premiums at 20-year lows. So if that doesn't happen, if we don't get that strong earnings recovery this year, then there will be a substantial bear market the moment the market realizes that these earnings expectations that it's expecting isn't actually coming to fruition. So that's the warning sign. The leading economic indicators are warning of an earnings recession coming. But here's my plan of action. The big 3 indicators that I'm watching: permanent job losers, the 10-year treasury yield versus the 2-year treasury yield, and then the S&P and NASDAQ 100 versus their respective 200-day moving average. Exponential moving average, I should say. So if we see a crossing of all 3 things happening together, permanent job losers rising above its 36-month EMA, the 2-year treasury yield crossing below the 10-year treasury yield. Okay, so that means that yield curve has re-steepened above 0, but it has to be that the 2-year crosses below the 10-year yield. Okay, and then the S&P 500 and or NASDAQ 100 fall below its 200-day EMA. When all three things happen, right, when these three stars align, then it's time to go full-blown defensive. In my view, this is just my personal opinion, my plan of attack. The first one just triggered in February as we got the jobs report. This one has now triggered, but we haven't yet seen 2 and 3 trigger yet. So right now, it's good. It's okay to be long the market, the S&P and the NASDAQ, because we have to, again, respect the trend. The trend is bullish. It wants to be bullish. So remain with the trend. Don't bet against the tape, as they say. Remain long S&P 500, remain long NASDAQ 100. But if we start to see these two trigger with the first one continuing to be triggered, then it's time to go full-blown defensive. And the way that I would be defensive is, these 4 sort of asset classes, 1 to 3 year Treasury ETF, that's the SHY, money market mutual funds, investment grade short-term corporate bonds, such as the JP Morgan Ultra Short Income ETF, that's JPST, and the Zacks Earnings Certain portfolio, specifically focusing on the companies with dividend growth and low Shiller PE, low beta, essentially positioned for a low growth environment. So these are the types of companies that we own in the Zacks Earnings Certain proxy, high quality businesses that are recession proof. That's where I would be allocated, plus short-term treasuries and short-term investment grade corporate bonds. So I hope you guys found that helpful. Again, I'd love to hear feedback from you on what you think specifically about my plan of attack right here on these 3 things: permanent job losers rising above the 3-year moving average, yield curve re-steepening above 0, and then finally, the S&P or NASDAQ falling below its 200-day moving average. Let me know what you think of that plan of attack or of any other charts and data points that I presented. You can reach us at 1-866-794-6065 or give us a call or send us an email at strategycall@zackspro.com. All right, thanks everyone, and hope to see you soon on a future Lunch and Learn webinar. Take care, everyone. Bye.